Hello students, welcome to Dr. B.R. Ambedkar Open University. Today we are going to learn about income and expenditure account. In today's session, we'll learn that what is income and expenditure account, purpose of preparing income and expenditure account, what's the basis of accounting for it, what items we include or exclude in income expenditure account, how we prepare this account, what's the difference between receipt and payment and income expenditure account, and balance sheet of non-trading organizations. So, before we get into what is income and expenditure account, let's go to some background of it. Income and expenditure account is prepared specifically for non-trading organization. We also call non-trading organizations as non-profit organizations because they don't aim for earning profit, they aim for providing service to the society and people. Income and expenditure account in non-trading organization serves as the profit and loss account. Similar to how profit and loss account is prepared for commercial organizations, income and expenditure account is prepared for non-profit organizations. Now, what is the difference between these two accounts? The profit and loss account, as the name suggests, shows profit, whereas we know that non-trading organization doesn't have the objective of earning profit. So, there we get surplus or deficit. So, these non-profit organizations or non-trading organizations, they prepare financial statements including receipt and payment account, income expenditure account and balance sheet. So, for whom exactly these accounts are prepared, what type of organizations follow it? These accounts are prepared for the organizations whose main motive is to serve the public, society or people. These type of organizations are like NGOs, clubs, charities, hospitals, schools who are trying to provide welfare. So, these account like income expenditure account has the similar treatment as profit and loss, but the aim is not earning profit. That's why it shows us surplus and deficit for the year, although the accounting treatment remains the same. What's the meaning of income expenditure account? Income and expenditure. So, the name only suggests that we are recording all the incomes as well as all the expenditure of that particular year in this account. So, it provides a summary of all revenue incomes and all revenue expenses for the accounting year, and it is prepared on accrual basis. What is accrual basis? Accrual basis shows us or tells us that any transaction which has taken place in that particular year will be recorded irrespective of when the amount or the cash has gone in, has gone out or has come in. Like for example, we have a rent to be paid for this year which we have paid previous year itself, means we have paid the rent in advance. So, the cash might have been deducted from the last year's account, but we will record it in this year because the transaction was supposed to be of this year. So, irrespective of when the cash has gone out or has come in, we have to record the transaction. Another example, let's say we have to pay the wages to the workers, but we have not yet paid, it is due for the payment which we will be probably paying in next year. That means that all the outstanding wages which we were supposed to pay this year in income and expenditure account, we will be entering the transaction for this year, although the cash will be deducted for the payment next year. So accrual basis tells us that we have to record the transaction in this. If the transaction belongs to this year, we have to enter this year irrespective of when the cash is being cash has inflow or outflow. Now let's see what is the main purpose of preparing income and expenditure account. It determines whether the organization has surplus or deficit. Although we are not aiming for profit or losses, we still get surplus and deficit. We call it surplus or deficit, means either we'll have surplus of income or we have more of expenditures, which shows the deficit. So instead of profit and loss, it gives us surplus and deficit amount. With that particular statement of income and expenditure, we can easily identify, or it helps us in planning, budgeting and evaluating the financial performance of our particular organization. Why do we need to understand or learn about the financial performance? It is required if we want to run that particular charitable trust, NGO or hospital for a longer period of time. We do need to have sufficient funds flowing inside the organization. So with income and expenditure, we get a clear picture whether we have sufficient funds to run the organization or not. If we don't have sufficient funds, then we have to check that how we can procure more funds. We have to check for our sources of income. We have to build the sources of income so that we can provide best of services to the society and people. So with income expenditure, when we get surplus or deficit amount, it tells us that how well we have managed that particular year with all the services provided, still having sufficient money to run for the next year. So income expenditure helps the organization plan efficiently, budget the whole year with all the income expenditure listed, and it also helps in evaluating the financial performance. What is the basis of accounting for income expenditure? As it is prepared on accrual basis. We just discussed that it is prepared on accrual basis. All the incomes earned, whether received or not, will be added. All the incomes made during the year, whether we have received or not, doesn't matter. If it is counted for the year, we have to add it in the account. All the expenses whether paid already or are due or already paid or not paid, still it will be included. All the expenses incurred means for this year we have utilized the service but still not paid, or we have paid in advance, both will come in the account. So it is prepared on accrual basis. Irrespective of when the funds flow, we have to record the transaction. This is the basis of accounting in income and expenditure. There are few items which we do include in income expenditure and few items we exclude in income expenditure. Let's see that what we include and what we exclude. In income, we consider subscriptions. What are subscriptions? Subscriptions are the amount which members pay to be member of the organization. They pay a subscription amount to be the member. So subscription, if they are paying a fee, that is an income for the organization, it will be included. Interest will be included. The interest which we receive from any kind of investment made outside, that interest will be considered as income. Then donations received from the people for general specific will come under this. We know donations are of mainly two types: general donations and special or specific donations. General donations of smaller amount will be considered as income, but any kind of donation which is of huge amount or for a specific purpose will be considered as capital donation. So all the general donations will be considered under income account. So this will be added on the income side because it is considered as revenue. Then sale of old items. If any kind of item which is being sold, then it will come under income, like sale of old newspaper, sale of old books, or any small item, then it will be considered under income. Now in expenditures, major item which we consider are salaries paid, rent paid, electricity, postage, repair, maintenance, depreciation. All these will be included in the expenditure slide. Now what is depreciation here? Depreciation is the reduced value of our asset. Why the asset has a reduced value? Because the asset is being used for a period, and due to the use there is some wear and tear for the asset. So the value of the asset has gone down because of the uses. So that reduced value is known as depreciation. For example, one asset is of 1 lakh. We have used it for 1 year. So some value of that asset will go down because of the uses. So at the end of the year, we might say that value of a asset now is 90,000. So 10,000 the value has gone down. That 10,000 is counted as depreciation. So the items which we include in income and expenditure are: in income side we include subscriptions, interest received, donation, sale of old items, rent received, all these will come. In expenditure side we count salaries paid, rent paid, electricity paid, postage, repairs, maintenances and depreciation. Now let's see what are the items which we don't consider to enter in income and expenditure account. In all the capital receipts and capital payments are not considered for the income and expenditure account. As the name suggests, it is of capital nature. All the revenue nature items only will be entered in income and expenditure account, not of capital nature. Capital nature and revenue nature, what's the difference? Capital nature is something which is for a longer duration of time, which is done for a very long period. That is capital receipts or capital payments. Whereas all the short duration expenses or incomes made will come under income and expenditure. It is of revenue nature because it is for shorter duration of time. Like purchase of a furniture, the furniture is going to stay in the business for a very long period of time. It will be of capital payment because we have paid to get the furniture. Similar way, if we buy a building, the amount is paid for building. Building is going to stay for a very long period of time or forever. So the amount spent on buying the building will be considered as of capital nature. Now let's see what is capital receipt. Capital receipt is for example, life membership fee means someone has paid once for the whole lifetime membership someone has taken. Now it is for very long period of time, it will be considered as capital receipts. Whereas then capital donations are there for specific purpose. A huge amount is paid to the non-trading organization for something specific, then it will be considered as capital receipt. Legacy, if we have received, what is legacy? Legacy is will of a person which the person has donated for the charitable purpose, then it will be considered as capital donation. So anything which is of a long duration of time and includes a huge amount will be considered as capital receipt. Now, what are capital payments? Capital payments, for example, purchase of some asset, like I said, we bought furniture or we bought building, or any kind of loan repayment. Let's say the organization has taken loan for some development, now we have to pay the amount to the bank again, then that repayment loan amount will be huge, then that will be considered as capital payment. So all the long duration items of huge amount involving will be considered of capital nature and will come under capital receipt or capital payment. Anything of small amount and smaller duration of time will be considered as revenue receipt. It will come under income expenditure. How do we measure this long and short term? Anything which is less than a year's time will be considered as revenue. Anything which is more than 1 year of time will be considered as long term. So these are the items which we include or exclude out of income and expenditure account. Now, how do we prepare income and expenditure account? Income and expenditure account starts with the receipt and payment account. Now, what is this receipt and payment account? Receipt and payment account is another account which is prepared under non-profit organization. And receipt and payment account, all the cash transactions are recorded. We record all cash transactions in receipt and payment account. Any kind of money gone out or coming in comes under receipt and payment account. So from the receipt and payment account, first we need to identify the revenue items, means which particularly belong to this year, which particularly belongs to this particular current year for which we are preparing the income and expenditure account. From receipt and payment account, we identify and we take out all those items. Anything which is of previous year or coming year, we have to exclude out. After picking up those items which are of current year, then we adjust all the accrued and prepaid items, means anything which is to be paid, which is outstanding, will be added. Anything which is already paid, that has to be excluded. So adjusting all the accrued and prepaid items, adding and deducting, we get the current amount of the particular year. So when we get the particular amount, correct amount of the particular year, that will go into income and expenditure account. We have to include whether the transaction is of cash or not, it doesn't matter. Means, like for example, depreciation. Now in depreciation, no cash is involved, because it is assumption which is made that a certain amount is depleted out of our asset, which is not actually a cash transaction. Like we have discussed the example that we have a asset of rupees 1 lakh, we have used it for a year and now the value is 10,000. That means now the value is 90,000. That means the value worth 10,000 is deducted or has vanished out of the asset value. Now exactly no cash has gone out, but still it is one loss or one expenditure for the organization. So the 10,000 will be recorded. So all non-cash items, if it belongs to the current year, will be added to income and expenditure account. Then once all the receipts, all the incomes and expenditures are successfully recorded, then we have to total both the side and identify whether the organization has gained some surplus or suffered some deficit. Surplus means any kind of benefit, deficit means any kind of loss we have got. So this is how we prepare income and expenditure account. So now we can see there is a format of income and expenditure account. There is one side, expenditure side, and there is a income side. Expenditure side comes to the debit, income side comes to the credit side. In expenditure, we have various type of expenditures in the organization, like we pay salaries, rent, depreciation, any miscellaneous expenses are there like wages, postage, then we have bought some newspapers or something. So all these will be expenditures. Now what are incomes? Our incomes are from subscriptions, donations, any interest is received, any miscellaneous income, probably rent received. Okay, so once all these incomes and expenditures are entered, these are the broad things which we have just discussed. There can be so many more which comes here. So once both the side items are successfully entered, then we compute both the side and we get a balancing figure. If we have the income side more than the expenditure side, there is a surplus. But if we have expenditure side more than the income, it is deficit. So either we are getting deficit or we are getting surplus. So simple terms if we have to put, we can say income minus expenditure is surplus, expenditures minus income gives the deficit. If incomes are more, then it will be surplus. If expenditures are more, it gives us deficit. Let's go through one example of income expenditure account. It is a youth club named as Sunrise. Sunrise Youth Club has prepared an income and expenditure account for the year ending 31st March 2025. They have entered few entries in their income expenditure. Let's look through it. In expenditure side, they have salaries worth rupees 30,000. They have paid rent and electricity of 12,000. They also bought stationery for 3,000. They paid for repair and maintenance of the asset 8,000. They also paid for postage 1,500. They also charged depreciation on the furniture 5,500. So they have a total amount of expenditure which is 60,000. So in the year they have spent 60,000 to get the operations done in the organization. While they were spending, they also have some incomes which they have entered in the income side. What are the incomes they had? They have subscriptions worth rupees 55,000. Donations they got of revenue nature 10,000. They also got some interest on investment 3,000. They sold some old newspapers worth 2,000, and there is some miscellaneous income of 1,000. So total income which they got during the year is 71,000, whereas their total expenditure was 60,000. That means our income is more than the expenditure. So income minus expenditure equal to surplus. So they got a surplus of 11,000. 71,000 minus 60,000, 11,000 was the surplus for the year. Now that surplus will be reinvested in the organization for further growth and operations. So this is how income and expenditure account is prepared in the non-trading organization. Now let's understand what is the difference between receipt and payment account and income expenditure account. Look same. Receipts means any kind of income and payments means something we have spent, right? Expenditure. But there is huge difference in both the accounts when we are doing it for non-trading organization. Receipt and payment account and income expenditure account shows two different things. Now let's understand what is the main difference between these two. First, what is the nature of both of these? Receipt and payment account and income expenditure both are prepared for non-trading organization, that we clearly know. But what is the nature? What's the purpose of two different things? receipt and payment account is prepared only to record, only to monitor all the cash transactions. Receipt and payment account keeps a track of all the cash transactions, whereas income expenditure account keeps a track of all the revenue transactions. Okay, so cash transactions will come under receipt and payment, income expenditure will only consider the revenue transactions. What is the basis of it? The receipt and payment account, this accounting is done on cash basis, whereas income expenditure account is prepared on accrual basis. Now what exactly this accrual basis or cash basis means? Cash basis counts every transaction which is of cash nature, irrespective of which year it belongs to. It can belong to previous year, it can belong to future year, but if it is spent during this year, that means it will be considered in receipt and payment account. But in case of income expenditure, it is all the current year transactions only we have to record and exclude any transaction which belongs to previous year or future year. So income expenditure only works on the current year, whereas receipt and payment works on the cash transactions, means whenever the cash has gone out or came in. What type of items are recorded in case of receipt and payment? All capital revenue items are recorded. If something is of capital nature, like capital donation or buying of asset, will be considered under receipt and payment, because we are calculating all the cash. So it doesn't matter if the transaction is of capital nature or revenue nature, it will come under receipt and payment account. Whereas in income expenditure account, only the revenue transactions will be considered, capital transactions will be excluded. So only the revenue nature which is of short term will be recorded in income and expenditure. Now what time period is considered for receipt and payment? Receipt and payment include all the transaction of past, current and future period. Means no transaction which is of which belongs to current or future will be ignored. If the amount is deducted, then irrespective of which year it belongs to, it will take place in receipt and payment account. But in income expenditure, only current year's transaction will be recorded. What is the result of both the account? In receipt and payment account, we see the closing balance, that is cash surplus and deficit. Only the cash transaction surplus and deficit will be calculated in receipt and payment account, which is the balancing figure. Whereas in income and expenditure account, all type of surplus and deficit will be recorded. Not only cash, but accrual basis transaction also are recorded. So a overall surplus and deficit is calculated for the year. This is the key point, that in receipt and payment only cash, surplus and deficit is calculated, whereas in income expenditure the surplus and deficit of a particular year will be calculated. There cash is the key point in receipt and payment. In income expenditure, surplus and deficit of year is the key point. Now let's come to balance sheet of non-trading organization. There are three accounts which are maintained in non-trading organization. What are the three accounts? First, receipt and payment account, income expenditure account and balance sheet. We have learned about receipt and payment account, which depends on the cash transaction. We learned about income expenditure account, which depends on revenue transactions. Now, based on receipt and payment, income and expenditure, we prepare balance sheet of non-trading accounts. So what is this balance sheet? Balance sheet is a statement. It is a statement which shows the financial position of non-trading organization. It is a statement which shows that where exactly our organization is standing when it comes to finance. It is a financial statement like commercial organizations that provides a snapshot or a picture of non-profit organizations' financial health on a specific date. Mainly it is prepared at the end of the financial year. So, at the end of the financial year, here on that date, the financial position is checked. The financial position which is checked at that time, it shows that where exactly the organization is standing. So, in non-profit organization or non-trading organization, this financial position is checked through this balance sheet. There are two sides of this balance sheet, asset side and liability side, which is similar to what commercial organization balance sheet look like. Asset side, we record all the transactions or all the elements what the organization owns. In liability side, we keep what the organization owes. Means liability side shows that what are the sources of income, and asset side shows that where we have utilized the amount. So, we have a format of the balance sheet. In liability side, what all items we put? We put capital fund, which is mainly the membership amount. Then what are the subscriptions received during the year? Outstanding wages. What are outstanding wages? Outstanding wages are the amount which are still pending for the payment, which we have not yet paid. And outstanding salaries also. In similar way, we can have outstanding rent. We can have loans which we have taken from bank. Any kind of debt also will come under the liability side. So, the major areas which we put under our liability side is the capital, the debt. In debt we have loans or any kind of borrowing from outsider. Then we have outstanding wages, outstanding salaries. In asset side, we have buildings. We can put buildings, furniture, any equipment, subscription received, prepaid rent and cash. So, this is how a balance sheet is prepared. So, to conclude, we can say income and expenditure account shows the true financial performance of non-trading organization. It is prepared on accrual basis. It includes only revenue items. It helps in putting transparency, accountability and efficient fund management, and the balance sheet shows the financial position of the organization. Thank you.